Hi everybody, and welcome back to video number 9 in chapter 17. And when we left off, we were looking at contract modifications involving separate performance obligation. So accounts for a new contract if both the following conditions are satisfied. Both. 1, promised goods or services are distinct, meaning the company sells them separately and they are not interdependent with other goods and services. And the company has the right to receive an amount of consideration that reflects the standalone selling price of the promised goods or services. Okay, let's take a look at an example, a contract modification example here with Crandall Company that has a contract to sell 100 products to a customer for $10,000, representing $100 per product at various points in time over a 6-month period. After 60 products have been delivered, Crandall modifies the contract by promising to deliver 20 more products for an additional $1,900 or $95 per product, which is the standalone selling price of the products at the time of the contract modification. Crandall regularly sells those products separately. So, how should Crandall account for this modification? In this situation, the contract modification for an additional 20 units is, in effect, a new and separate contract because it meets both the conditions above. That is, it does not affect the accounting of the original contract. So given the new contract, Crandall recognizes an additional $4,000. That's 100 units less 60 units times $40, or $100, related to the original contract terms, and then an additional $1,900 for 20 units at $95 related to the new products. Total revenue after the modification is therefore $5,900, representing $4,000 plus $1,900. All right, what about a prospective modification? If Crandall determines additional products are not a separate performance obligation, 1, they account for the effect of the change in the period of the change as well as future periods if change affects both. And 2, they do not change previously reported results. All right, so if this is the case, then consideration for products not yet delivered, that's the $4,000, and consideration for the products to be delivered, $1,900. So the remaining revenue is $5,900. So we would take the revenues per the remaining units, 60 units here, divided into the $5,900, and then each unit would be would earn revenue at $98.33. Okay, under the prospective approach, a blended price is used for sales in the period after the modification. So, revenue recognized prior to the modification under excuse me, okay, so if revenue is recognized prior to modification, then we're going to have a separate performance obligation for $6,000 and no performance obligation prospectively. Now, if the revenue is recognized after modification, then we have a separate performance obligation of $5,900 and no separate performance obligation prospectively. And finally, the total revenue that we're going to recognize will be $11,900 and $11,900 with a blended price here of $98.33. Okay, costs to fulfill a contract. Companies divide fulfillment costs, contract acquisition costs, into two categories. Number one, those that give rise to an asset, and number two, those that are expensed as incurred. So, here is an example. Rock Integrators enters into a contract to operate Dell Company's information technology data center for 5 years. Rock Integrators incurs selling commission costs of $10,000 to obtain the contract. Before performing the services, Rock Integrators designs and builds a technology platform that interfaces with Dell systems. That platform is not transferred to Dell. Dell promises to pay a fixed fee of $20,000 per month. Rock Integrators incurs the following additional costs: design services for the platform, $40,000. Hardware for the platform, $120,000. And the testing of the data center, $100,000. What are Rock Integrators' costs for fulfilling the contract with Dell? And as we look at the solution, the $10,000 selling commission cost related to obtaining the contract is recognized as an asset. The design services cost of $40,000 and the hardware for the platform of $120,000 are also capitalized. As the technology platform is independent of the contract, the pattern of amortization of this platform may not be related to the terms of the contract. Testing costs are expensed as incurred, and in general, these costs are not recoverable. All right, disclosure. Companies will disclose qualitative and quantitative information about the following: contracts with customers, significant judgments, and assets recognized from costs incurred to fulfill a contract. So, here's the categories of revenue disclosures. Here is a disaggregation of revenue. Here we're going to disclose disaggregated revenue information in categories that depict how the nature, amount, timing, and uncertainty of revenue and cash flows are affected by economic factors. Reconcile the disaggregated revenue to revenue for reportable segments. Number two, reconciliation of contract balances. Here, we're going to disclose opening and closing balances or contract assets, such as unbilled receivables, and liabilities, such as deferred revenue, and provide a qualitative description of significant changes in these amounts. We'll disclose the amount of revenue recognized in the current period related to performance obligations satisfied in a prior period. For example, from contracts with variable consideration, and disclose the opening and closing balances of trade receivables if not presented elsewhere. For number three, remaining performance obligations, here we'll disclose the amount of the transaction price allocated to the remaining performance obligations not subject to significant revenue reversal, and will provide a narrative discussion of the potential additional revenue in constrained arrangements. In the fourth category, cost to obtain or fulfill contracts, we disclose the closing balances or capitalized costs to obtain and fulfill a contract, and the amount of the amortization in the period. We'll disclose the method used to determine amortization for each reporting period. And finally, other qualitative disclosures will disclose significant judgments and changes in judgments that affect the amount and timing of revenue from contracts with customers. We'll disclose how management determines the minimum amount of revenue not subject to the variable consideration constraint. Okay, let's look now at applying the percentage of completion method for long-term contracts. Here, if we recognize revenue over time, a company satisfies a performance obligation and recognizes revenue over time if at least one of the following three criteria is met. Number one, the customer simultaneously receives and consumes the benefits of the seller's performance as the seller performs. Number two, the company's performance creates or enhances an asset, for example, work in process, that the customer controls as the asset is created or enhanced. Or number three, the company's performance does not create an asset with an alternative use. All right, long-term construction contracts. There's two methods of accounting for these contracts. One, percentage of completion method. Here, we're going to recognize the revenues and gross profits each period based on the progress of the construction. And buyers and sellers have enforceable rights. And then we have number two, completed contract method. And here we're going to recognize revenues and gross profits only when the contract is completed. Okay, input. Based on a company's efforts or inputs towards satisfying a performance obligation relative to the total expected inputs to the satisfaction of that performance obligation. Here, resources consumed, costs incurred, time elapsed, labor hours expended, machine hours used. The output is going to be based on the direct measurement of the value to the customer's goods or services transferred to date relative to the remaining goods or services promised under the contract. And examples would include surveys of performance to date, appraisals of results achieved, milestones reached, or time elapsed. Okay, so the percentage of completion method, a cost-to-cost basis here. Here, we're going to do a series of calculations. We'll take the costs incurred to date divided by the most recent estimate of the total costs, and that'll give us our percentage complete. Then we'll multiply the percentage complete times the estimated total revenue, or it could be gross profit, and that's going to give us the revenue or gross profit to be recognized to date. And once we have that, then we have the revenue or gross profit to be recognized to date. We subtract out the revenue or gross profit recognized in prior periods, and that will give us the current period's revenue or gross profit for this period. Okay, an example. Hard Hat Corporation has a contract to construct $4.5 million bridge at an estimated cost of $4 million. The contract is going to start July 2025, and the bridge is to be completed in October 2027. The following data pertain to the construction period. And here we have our costs to date, our estimated cost to complete, the progress billing during the year, and the cash collected during the year. This looks like a good place for us to stop this video, and when we return, we'll take a look at applying that percentage of completion method and on a cost-to-cost basis. Until that time, bye for now.